I've read over 100 books on money, so you don't have to. And here's the 5 most important things that I've learned. And be sure to stay to the end because the last one's the most important. Okay, let's go for a walk and let's talk about these 5 lessons. The first one is we've all heard money doesn't buy you happiness. And while it may not buy you happiness, you know what it does buy? It buys freedom. And what is freedom? Freedom is the ability to do what you want, when you want, and with whom you want. And that's an incredibly valuable thing, right? Oftentimes we don't get that kind of freedom until we retire. But if you can get control over your money, if you can figure out how to spend less than what you earn, if you can figure out how to invest it, you can start building up that nest egg and reach the point where you have that kind of freedom for whatever you want to do. You know, for a lot of people, we want to be kind of time agnostic with our work. We want to be able to work when we want to work, where we want to work from, and again, with whom we want to work. So super valuable tool. And, you know, that's really what money is. Money is a means of exchange, right? Here I am on this wooded trail here. If I was here by myself in the world and there was nobody else, truthfully, money would have no value, right? It's really when we live with other people, we're interacting with other people, we're doing commerce with other people, that money has value. So number 1 is it can buy you freedom, and that's incredibly important. Okay, number 2 is when it comes to investments, right, it's not enough to save your money. You heard me say earlier, you have to spend less than you earn. You have to save that money, but that's not enough. You have to invest it. And when it comes to investments, there's really 2 classes of investments. And I'm not talking about real estate or stocks or private equity. I'm talking about investments that are designed to be bought versus investments that are designed to be sold. And unfortunately, the vast majority of investments are designed to be sold to you. They have high commissions associated with them. The people that are saying, hey, you should make this investment, oftentimes don't have your best interest in mind. They're really salespeople trying to sell you something. So an investment tool, for me personally, I think annuities fall into this category. I'm not an annuities expert, but oftentimes annuities have a lot of bells and whistles that sound really good. But you have to read the fine print, right? There's nothing for free. So if it's got these nice bells and whistles, well, it probably has some downsides associated with it too. And you really need somebody that has your best interest in mind, unless you're going to do a ton of research. So most investments, unfortunately, are designed to be sold. Now, if you get to the basics, right? High quality, short duration, bonds from strong corporations. Those are designed to be purchased, right? You do your research, you find out which companies you believe in. You know, is Walmart going to be around in 100 years? I have no idea, right? I mean, the world changes so quickly, and 100 years is a long, long time. But is Walmart going to be around in 3 years to repay bonds that you might buy, high quality bonds from Walmart? You know, I'm highly, highly confident that Walmart is going to be able to repay those bonds. Again, no guarantee. Same thing with stocks, you know, is stocks in good companies. And I'm not going to mention specific companies, but market leaders that have great management teams, strong balance sheets, wide competitive moats. Those companies, those stocks are designed to be researched and bought versus being sold, right? Oftentimes actively managed mutual funds that have high fees. Those are designed to be sold to you by somebody that comes to you and says, hey, I think you should make this investment. You know, normally if you're getting pitched a product at the country club or by one of your buddies, you know, likely either your buddy has a financial incentive for you to invest in the product, or somebody that had a financial incentive encouraged your buddy to buy. So just be careful. You want to do your research, or you want to hire somebody that's an expert that has a fiduciary responsibility to you 100% of the time. One way to find somebody like that is just to Google a fee-only financial advisor. Fee-only financial advisors have voluntarily said, we're going to put our clients ahead of ourselves. We're going to be fiduciaries to our clients 100% of the time. So just be careful that the investments that you make are investments that somebody's done the research and they've gone out and looked for the best investment in this area, as opposed to, here's an average product that we're going to pay somebody a good commission to raise money. So that's number two. Okay, number three. Number three is decisions matter. And I think decisions matter a lot. Some decisions can really derail you. I mentioned earlier annuities. Annuities can lock you in for a period of time, and they have surrender fees associated with it. And that can be a costly mistake. And even simple tools, right? I mentioned earlier about, bonds and keeping things simple and doing your research. A U.S. Treasury bond, a couple years ago, a 30-year U.S. Treasury bond, right? It's backed by the U.S. government, so it has no issuer risk. But people were buying 30-year bonds at, like 1%. Essentially it was all risk with no return, because if interest rates rise by 1%, and all of a sudden 30-year bonds, instead of paying 1%, are paying 2% or above that now, that extra 1% over 30 years has a dramatic impact on the value of that bond. Yes, the U.S. government's going to pay you back your money, but if you tried to sell that bond in the open market, that 1% increase in interest rates, right, for somebody over 30 years, that's worth an extra percent every year. So in theory, a new 30-year bond is worth almost 30% more. Now, for a variety of reasons, it's probably going to be closer to 20%. But in theory, back then, a 1% increase in interest rates is going to decrease the value of a 30-year U.S. Treasury, the least amount of creditor risk on the market. But still, you could lose 20%. So, decisions matter. Make sure that you do your research. As I said earlier, if you don't have somebody to do the research for you, if you don't want to do the research, hire somebody that will, because the research really does matter. So this is on the investment front, but decisions also matter as to how you're going to invest your money, right? What's your asset allocation going to be? If you're in your 50s and your whole life you've been comfortable with risk, and you're getting close to retiring, likely your attitude about risk is going to change. And having somebody that's been a river guide for other families that have helped other people navigate the journey that you're about to go through for the one and only time in your life, having a river guide that's helped hundreds of families do that can really help you make good decisions that you'll look back on and say, you know what, I made the right decision. Maybe in my 30s and 40s, I was comfortable with 100% stock allocation, but maybe in your 50s and 60s, boy, a 40% market correction is going to feel a lot different once you quit making money. And having somebody on your team that knows that, it can help advise you and help you make the right decision on your asset allocation and help you stay the course when times are scary, and knows that you make the asset allocation decision not based on the good times, but on the scary times, and knows both what you're saying and what you're not saying, and can help you and your family make the decision that's right for you. And asset allocation is just one example of that. How do you save for your kids' college education? Should you pay off your mortgage? Should you not? Lease your car, buy your car versus buy your car outright versus buy a used car, and tell you if you should buy a used car as opposed to a new car. Having somebody on your side that's been through it before is super valuable. Okay, let's keep going. Let's see, we're on number 4 now. And number 4 is, I just want to share with you that, and I think instinctively we know this, but I think it's worthwhile saying it. Over 80% of millionaires in the United States are first generation millionaires. So they didn't come from money. There's been a study done, and there's different categories, but one of the more famous studies is a category that looks at millionaires in the United States and really categorizes them into 4 categories. And this is for first-time millionaires. Somebody's a virtuoso, and a virtuoso is somebody that has a high level of skill, typically a high level of education or trade, whether that's college or trade education. And they're very, very good at what they do. So typical examples might be like a surgeon, an attorney, or a Lamborghini mechanic, somebody that has a high level of specialization. So that's a virtuoso, and that's less than 10% of U.S. millionaires. The next one is entrepreneurs. We know what entrepreneurs are. They took risks. They started a company. They built something from nothing. It's really the American story, but the reality is that's less than 10% of the millionaires in America. The next group is corporate ladder climbers, corporate executives. Tends to be Fortune 500 executives, big companies executives that have spent their life helping to build their companies. They know how to make things happen in a big organization, and they're very valuable people to the corporation. And so that's 20%. So so far we've identified less than half of the millionaire population, first generation. The vast majority of millionaires in America are probably folks like you and me. Folks that have our whole lives have saved up our money. We've sacrificed a little bit, hopefully not too much. And not only have we saved the money, but we've invested it. We've made good investment decisions, and those investments have compounded in value. And so that's the vast majority. That's 60% of first generation millionaires. So decisions matter, and just doing the right things, doing the fundamentals, focusing on the fundamentals. Okay, the fifth one, and then I've got a bonus one for you, which is the last one. So be sure to stay to the end. By the way, if you're enjoying this video, if it's helpful, again, over 100 books that I've read and sharing the main insights, the main lessons. If you're enjoying the video, give me a thumbs up. It really does help the YouTube algorithm. Please do take a second so that other people can find this video as well. Thank you. I appreciate it. Okay, number 5, and that is, it's ironic, but it's like a lot of things in life. The fear of losing money, I think, actually makes it more likely that you're going to lose money, right? Some people are holding on too tight. They're watching every penny. They're just super strict and really watching things very closely, and they're trying to control something that's not controllable, right? We don't control the U.S. economy. We don't control what happens in the U.S. stock market. What we can do, though, is get things directionally correct, right? We can get our asset allocation right so we don't blow out of our investments at the wrong time. But if you're trying to, oh, gee, my investment manager should have seen this recession coming. The truth is nobody can time the market. Nobody, period. Who is it that, Jack Bogle, the founder of Vanguard, said, I can't time the market. I don't know anybody that can time the market, and I don't know anybody that knows anybody that can time the market. So there's a whole bunch of people that can get market timing correct once, but there's nobody that's been able to do it consistently, time in and time out. And you're much better served, multiple studies have shown you're much better served with time in the market as opposed to trying to time the market. So fear can be your worst enemy, and over control can be your worst enemy. And the problem with fear is if you're trying to avoid loss, and I'm trying to control this and I'm making all the right decisions, you are much more likely to blow out of the stock market at exactly the wrong time, at the bottom. And decisions like that, I said earlier, decisions matter. And that's the type of decision that can have a lasting impact and can change the quality of your retirement. So what do you do instead? I think, really what you're looking to do is you're looking to surround yourself with people that you trust, that this is what they do for a living. You've chosen them because you believe in their strategy. It's something that you're comfortable with. It's a strategy you believe in. If it's a black box and you really don't know how the investment strategy works, you're going to be highly likely to blow out of the market the first time they have a down year. There's a lot of strategies that can work, right? But the firm has to be disciplined with it. So you want somebody that's been through several investment cycles, which unfortunately, my industry tend to be 7 to 10 years. So, I would argue you probably want like a 20-year track record of somebody that has an investment strategy that you understand high level and you agree with, and you trust the team, and you have somebody on that team that's going to help you continue to stay the course and make good decisions along the way. So getting back to the main point, fear can be your worst enemy if you're trying to hold on too tight. Those people never get to enjoy their money, unfortunately. If you have anxiety, let's say I'm just going to throw out numbers. You want to have $2.5 million to retire, and you have $1 million now, and you're holding on tightly, and you've got a lot of anxiety. I hate to tell you this, but if you have $2.5 million, you're going to have just as much anxiety, maybe more. Even if you keep working, it keeps compounding, and you have $5 million. That anxiety is never going to end. You're never going to enjoy your money. So it's a hard habit. It's a hard practice to end. But I think the way you do that is really picking. I think you need an advisor, right? You need an advisor to help you on the journey if you're too fearful, if you're trying to control things. Somebody that you trust that can walk the path with you, and that has helped multiple families over several market cycles, have helped them succeed, that can really, hold your hand and be there with you and keep you calm when it's the most important to be calm. So anyways, that's a super important one, but it's not the most important one. The most important lesson is what does work, right? So holding on too tightly, trying to control things doesn't work. I mentioned decisions matter. I mentioned about getting the asset allocation right. I mentioned about the freedom, but what does work? And what I have found that works is having at least some sense of gratitude, right? For what we have. I mean, there's very few people watching this video that are ever going to have to worry about having a roof over their head and food on their table. Now, unfortunately, in the U.S., healthcare is an issue, but fortunately, most of us are going to get Medicare, at least by the time we're 65. But, really have gratitude for what we have, because in some countries, a roof over your head and food on the table is not guaranteed. So we're fortunate there. So having gratitude, I think the goal should be trying to get things directionally correct, not trying to optimize. Boy, if you're, let's say you have a little bit of dry powder, it's personally what I do, right? I don't try to time the market, but my personal strategy for dealing with scary times is I like to have about 10% of my account in cash, sometimes more. And the purpose of that is when times get scary, it allows me to buy something inexpensively. Now, I know emotionally that my money is better off being in the market 100% of the time, right? I'm probably over an investment cycle going to do better by just leaving that money fully invested. But I also know I like a deal. I like a bargain. And when times are scary and the news has a lot of bad news on it, boy, me being able to buy something inexpensively with cash, because if you don't have cash, what you're probably doing in scary times is you're selling something inexpensively at a price below what you want to sell it for to buy something at a low price. And is that really a bargain? I would argue it's not. But if you have cash, you can view it as an opportunity. And for me, you don't want to take it to an extreme, but again, directionally correct, right? 10% of my portfolio is not going to hurt me if it sits in cash. And then when times get scary, I can say, oh, I want to buy this company. I've always admired this company, and I wasn't willing to pay the current market price, but now it's on sale. Now it's 30 or 40% off. And by the way, so's the rest of my portfolio probably, right? But I have some cash to buy that, and it makes me feel like it's an opportunity. So directionally correct. Okay, what else works? I mentioned hiring a guide. I think it's critically important if you go that direction that you get somebody that's a fiduciary to you 100% of the time. One way you can do that is by hiring a fee-only financial advisor. Just Google that term, you'll be able to find somebody. I should mention none of this is financial advice. This is just financial education that I'm sharing with you in today's video and giving you some things to think about and research yourself or reach out to a financial advisor that knows your specific situation and can give you advice specific to you. You know, nobody on YouTube, unfortunately, can give you financial advice because we don't know your situation. Okay, continuing to move on. What does work? I think this is the most important section. Again, if you haven't given me a thumbs up, please take a second and do that. I think having an abundance mentality is super important and super helpful, right? If you feel like, you know, it's me versus them, and if I gain $1, you know, I'm taking it away from somebody else. I think we can all win and win together. And so having that abundance mentality that, again, you don't have to hold on too tightly. Also, not comparing yourself to other people. I guarantee you, there's going to be people that, you know, are going to say, "Oh, I got out of the market just before things, you know, went crazy," and you know, maybe they did once, or maybe they did, or maybe they didn't, right? I've been in this industry a long time, and I've seen people's financial statements versus what they've told me over the phone. And oftentimes you're hearing the truth, but not the whole truth. So don't compare yourself to others. It's one of the quickest way to just to lose the joy and to lose your confidence. Envy and jealousy is something we all have to work on, but you know, there's always going to be somebody that's done better than you. But the question is, are you directionally heading in the right area? And trying to chase last year's winners is one of the quickest way to get your butt handed to you in investing. So don't do that. Okay, and then finally, the last one is what is typically credited to Einstein, and he said, you know, the eighth wonder of the world is compounding. So, you know, start saving that money, start investing it, let that money grow, let that money work harder for you than you did to earn that money in the first place. And the only way to do that is you have to spend less than what you earn, you save it, but then you also have to invest it, and you have to make good decisions. You have to invest it wisely. So again, I hope this was helpful. If it was helpful, as the kids say, thumbs for likes and subs for love. If you haven't subscribed, please do subscribe. Leave me a comment in the comment section. I do read the videos. I do read the comments every day. They're super motivational. And until next time, I'm Azul, encouraging you to take full advantage of the youth of your senior years. Remember, we're only young once. Let's use our time wisely.